I think Brussels at the moment is less of a factor here. I think it's the national capitals, as you said, that need to get their act together. And there has definitely been a wake-up call over the past 18 months since President Trump got elected for the second time round. And the Europeans know they need to shape up, but exactly how they're going to do it and how joined up they're going to be, that's still up in the air.
The image of a French aircraft carrier with 7 destroyers around it, I mean, with a submarine sinking of a boat in the Indian Ocean, I mean, what is the symbolism to Europe of the French moving east to the Middle East?
I think that's very significant. I think also the offer by President Macron to make the force de frappe potentially available in forward deployment for allies. I mean, that's a big development that happened, what was it, 2 weeks ago? We've talked about it, but I think one can't talk about it enough. The Germans doubling their defense budget very quickly and moving away from their balanced budget orthodoxy, I think, is a big move. Now, all of that's happening right now, but it's not in a joined-up manner. And I think that's what we're waiting for. That's why you asked about Brussels, but Brussels isn't going to be the factor here. It's the national capitals and domestic politics that are going to determine that.
I should mention the ship, Damien Sassauer, the Charles de Gaulle. I mean,
yes,
how could there be any other ship named the French fleet?
Andreas, markets are clearly reacting to the Middle East conflict, but relative to past events, I mean, the price action just appears to be, quite muted to me. I'm curious to hear your thoughts on that. Do you see potential for the current conflict to metastasize into a full-blown VAR shock? And I guess, do you see any risk to the plumbing underneath these financial markets right here?
Of course it could totally spiral out of control. I mean, we don't know. You don't know. I think nobody really knows. The markets are certainly not discounting it. Otherwise, you'd have seen you're quite right, a much stronger reaction downward. And it is really surprising that the markets have been so sanguine. I have to say I agree with the biggest risk to the plumbing is the potential hazards in the private credit space.
There we go.
I totally agree. Sorry, I'm being
right
boring.
Where we want
telling
to go.
You what you
I've
what
been
you want to
sitting
hear.
here sweating, Tom, waiting for that to come. I mean, come on. Continuation vehicles, deteriorating CLO demand. Come on.
Andreas, you don't know this, but on Damien's screen, he has a countdown clock. Given Iran, given the president, given the press conference coming up, Tom, when are we going to talk about private credit? Go.
But let's talk about base principles first, right? I mean, I was having that conversation with a friend of mine the other day. I said, look, I grew up a banker, right, in the 80s. I saw how loans are being made to mid and small-sized corporates.
Commercial paper.
Absolutely. I know how much due diligence went into all of that and why. Because the capital of the banks are at stake.
That's right.
Right?
Collateral markets, funding.
It's real money, right? Now you move this kind of off balance sheet with everything that's happened post Great Financial Crisis, and whose money is now at risk? It's sort of anonymous savers, right? So how do you think the due diligence compares relative to a bank that extends these loans on their own balance sheet? It's going to be subpar.
So, Andreas, do you think global creditors should be more concerned with what's going on in B-Cred and some of these credit instruments as opposed to what's going on in the Middle East? I mean, I think that's what you're saying here.
Well, we'll know after the event, but certainly the market should be concerned about that, absolutely.
How large are those shadows? I mean, you guys are way too young to remember this, but I remember going on an October, I think, Thursday with a martini in my hand. Oh, portfolio
As
insurance. What is that? What's the fear that you have now of, is that pure leverage, is it? What's the unknown of private credit, Andreas?
Well, I don't know. I'm not smart enough to know the unknown unknowns. But what I can tell you is I'm slightly less concerned than I was, and I was concerned in 2007, 8, and 9.
Yeah.
Because ultimately, the transmission mechanism of this going wrong initially is going to be probably consumers, savers, and not systemically into the banking system.
Yeah.
Now, as you say, there might be unknown unknowns. I mean, one of our competitors in Switzerland had loans on the balance sheet nobody knew about, and so that was an unknown. And who knows what banks have done that nobody knows about, but right now there's no evidence of that.
You know, one of the big buyers in that market are insurance companies, right?
Yep.
I mean, long duration buyers. And, you know, to me, I mean, I look at insurance and, you know, it's
And
very
they've done very
difficult.
well, right? Insurance stocks, particularly in Europe.
So that's what I'm thinking. I mean, and I'm wondering if you have any thoughts there. I mean, demand from insurers for, you know, 30-year paper, for long duration paper has kind of gone down as you've moved into the private credit market, right? That's short duration, you know, that's short duration stuff. You know, talk to us about the potential for asset liability mismatching in the insurance industry. I mean, the insurance industry, by the way, Tom, for all our audience listening, is one of the best performing sectors in the S&P this year. So I'm just curious to hear your thoughts there.
Well, as you know, I worked for Allianz for a long time. I was on the asset management side, but clearly they farmed out some of the some of their investments to Allianz Global Investors, the firm I was leading, and PIMCO. And you're right. I think in the 2010s, when interest rates were ultra low, they went ultra long. Now, to my surprise, not entire surprise though, they did manage that transition extremely well.
Yeah.
So they didn't really take the hits that you might have expected as interest rates rose. And so that speaks to their ability to manage risk on their balance sheet. So I've also seen the insurance stocks do really, really well.
Really well.
So that there's no real evidence at the moment that they're not managing this appropriately. So I'm kind of bullish on insurance.